Hello, and welcome to the Federal Income Taxation for Family Forest Owners, an overview. This module was created for the How to Manage Your Forest series by Dr. Norman Elwood and me, Bob Parker. I'll be your narrator for this module. Oregon's woodland owners face several types of taxes: local property taxes, state severance and harvest taxes on harvested timber, state and federal taxes on income from forest operations, and last, possibly federal estate taxes on the woodland portion of an owner's estate. This presentation highlights key aspects of federal income tax laws and regulations, specifically related to operations on family forest properties. Our purpose is to review briefly how the federal government taxes income from forest operations, key tax topics to help avoid problems and minimize taxes, what expenses are deductible, and where to get help with forest income tax questions and problems, and what questions to ask. This presentation is for educational purposes only and should not replace study of pertinent tax literature, nor should it replace counsel from qualified tax and legal professionals. We strongly encourage you to consult other publications in the OSU Extension Service Woodland Workbook series and other resources listed in the For More Information slide. The general concept of federal taxation is simple. Owners invest money in their woodland operations. When they sell timber or other forest products, they expect to make a profit. In turn, the government expects revenue by taxing that profit. The tax calculation allows for pertinent costs and investments necessary to generate the income and adjust for certain losses, if any. Some costs may be deducted in full on the tax return for the year in which the costs were incurred. Other costs must be carried on the books. They will then be deducted either over a specific period, usually years, or when a sale occurs. Family forest owners occasionally lose timber and forest products to natural disasters, such as flood, tornadoes, insects, disease, and so on, or even theft. Federal income tax law has special rules to lessen the financial impact of such losses to owners. A good place to start into the tax topics is with an understanding of basis and depletion. Basis is an important tax concept. It is the benchmark for the maximum legitimately deductible costs invested in the property and timber. Family forest owners are not expected to pay taxes on their original investment in property and timber, only on the financial gain that the investment produces. Thus, owners may deduct from gross sales or revenue the amount originally invested in the timber being sold, plus or minus subsequent adjustments to that basis. Original basis is the total amount of money invested in acquiring a property and all related assets such as timber, land, fences, the house, etc. It is easiest to establish original basis immediately on acquiring the property. This saves considerable work and perhaps expense to establish it later. Establishing basis, especially years after purchase, may require a forestry consultant and/or appraiser to determine timber value and volumes. When original basis changes to reflect capital improvements and deductions for depletion, depreciation, amortization, or losses, the result is then called adjusted basis. Now let's talk about depletion. The process of depletion reflects the using up or gradual reduction of a natural resource. It can be thought of as similar to depreciation, which reflects the wearing out of machinery, equipment, and other such assets. If you sell all the timber on your property, a depletion allowance may be taken equal to the entire timber basis. If you sell only part of the timber, the depletion allowance is prorated according to the volume sold. In both cases, the depletion allowance is advantageous because it lowers the final amount on which you must pay tax. Failure to properly use basis and depletion deductions can result in paying unnecessary taxes. Another issue with significant effect on the amount of tax owed is the category of forest activity. For tax purposes, a woodland operation can be classified in one of three categories: personal use, investment, or business. You must make this determination each tax year. Property and assets in the personal use category are not used to produce income. The house and land that are your personal residence are examples. The investment category is for property and assets that are not primary or major sources of income, but which are managed for profit. Investors conduct some management, but generally infrequently and at a low intensity. The business category contains those profit-oriented operations conducted with sufficient regularity and intensity to be bona fide businesses. Businesses are further differentiated as active or passive based on whether the owner materially participates. Material participation is usually determined by the number of hours devoted each year to managing the forest operation. While the IRS uses the number of hours devoted annually to woodland management, hours alone are not the sole criterion. The other criteria, however, are not as clearly defined as hours and fall into a catch-all category called facts and circumstances. This merely means that the IRS does a comprehensive review of your entire woodland operation when making the determination. In addition to the number of hours involved, the review might include, for example, the size of your woodland, the frequency, type, and magnitude of activities, and whether your intent in owning the property is for personal, business, or investment use. The PowerPoint slide shown here summarizes what we have just discussed. The business category generally offers the best tax advantages. Generally, businesses can fully deduct operating and management expenses, but investors cannot. Since we've just mentioned the deductibility of various costs based on category of activity, we should say a bit about the type of costs incurred in forest operation and their relationship to taxes. For federal income tax purposes, costs related to family forest operations are classified into three categories: capital costs, operating expenses and carrying charges, and expenses of sale. Capital costs are associated with acquisition of property or property rights and improvements that increase the value of property already owned. Examples include expenses for purchasing land, timber, buildings, and machinery having a useful life of more than 1 year, building roads, bridges, and fire breaks, reforestation activities, or major equipment repairs that prolong the life of the equipment. Capital costs must be capitalized, that is, carried on your books in appropriate accounts. They will be deducted over a period of years through allowances for depreciation, depletion, or amortization, which we will discuss shortly. Or they're deducted at the time of property disposition. Operating expenses is a broad category including all costs that are not capital costs and are not associated with disposing of the asset. Examples include expenses for tools having a short useful life, such as axes, handsaws, wedges, and so on, salaries and wages for some types of hired labor, professional fees, certain taxes and fees like harvest and severance taxes, certain interest payments that you make, certain insurance premiums, travel expenses, and rental payments. Businesses deduct operating expenses from gross business income. Investors deduct operating expenses as itemized deductions. Carrying charges include costs relating to holding or owning a property and development costs. Examples of holding costs are annual property taxes, mortgage interest, and insurance premiums. Owners may choose each year whether to capitalize holding costs or to deduct them on the current year's tax return. The deductibility of carrying charges varies considerably between businesses and investors depending on the exact nature of the carrying charge. Examples of development costs are fertilizing, pruning, and pre-commercial thinning. An owner must decide whether to capitalize or deduct these costs. The decision is made in the first year development costs are incurred. Subsequently, all development costs must be handled in the same way. Sale expenses are all costs associated with a timber sale or other form of timber disposal. Examples include timber cruising, marking, scaling, consultant fees, and certain travel expenses. Sale expenses generally are deducted from sale proceeds in computing net gain from the sale. Now, having discussed costs related to family forest operations, let's turn to the other side of the coin, income, its general types and how each is generated and handled tax-wise. Unincorporated family forest operations generate two types of income, ordinary income and capital gain. Ordinary income includes rent received for the use of your property, proceeds from the sale of logs, lumber, or other products from your timber, interest paid to you, and miscellaneous income. Capital gain is profit from the sale or exchange of a capital asset. It is either short or long-term capital gain, depending on how long you have owned the asset. Timber owned more than 1 year is a capital asset and will produce either a long-term capital gain or loss when disposed of or sold. Ordinary income and long-term capital gain are taxed at different rates. Capital gain rates are usually lower than ordinary income tax rates. The rules governing taxing capital gain income are complex and subject to change by Congress. Check with your tax professional for the most current tax rates. Income from family forest operations generally comes in large irregular amounts. This is often a disadvantage because it may bump you into a higher tax bracket for the year the income is received. Thus, you can help yourself by planning ahead to those years when the operation is expected to generate income. Careful planning and timing of income can help level the financial peaks and valleys, minimize the overall tax burden, and foster a more comprehensive approach to woodland management. Smaller, more frequent product sales is just one example of planning to manage income. Timber sales can generate both ordinary and long-term capital gain income, depending on the type of sale. The IRS generally accepts as long-term capital gain the profit from two categories of timber sales: stumpage sales and cut logs. Stumpage sales are sales of standing timber. Internal Revenue Code 631B provides the rules by which stumpage sale income is treated as long-term capital gain. Lump sum and scale-out contracts are two specific types of stumpage sales. Scale-out sales are also called pay-as-cut, Section 631B, and point-of-measure sales. The only sale of cut logs eligible to produce long-term capital gain is the Section 631A sale. If your woodland operation is a business, the income from a 631A sale is taxed in two parts. Part will receive long-term capital gain treatment, and part is taxed as ordinary income. To receive the tax benefit of the 631A sale, you must make a one-time, permanent, written election that is filed on an original, not an amended tax return in the year of the sale, and then follow the 631A tax calculation rules for all future sales of cut logs. For more detail, see the Forest Landowner's Guide to the Federal Income Tax publication, noted on the For More Information PowerPoint slide at the end of this presentation. Family forest owners occasionally receive income from sources other than timber or product sales. Examples include government cost-share programs. The general rule is that cost-share payments must be treated as ordinary income for tax purposes. Current exceptions permit excluding payments from income if they are from qualifying cost-share and incentive programs. Check with your appropriate state agency that handles cost-share and incentive programs. In many cases, this will be your state forestry agency. Special rules govern exactly how much income can be excluded and how the excluded income must be handled for tax purposes. Preserving one's hard-earned income is, of course, everyone's objective. Minimizing the tax owed by taking advantage of tax write-offs, deductions, and credits is an important way to reduce your tax burden and preserve income. With that in mind, let's talk about reforestation and amortization deductions next. The reforestation deduction allows woodland owners to deduct qualified reforestation expenses up to the first $10,000 annually. This includes the direct cost to establish or reestablish a timber stand by planting, seeding, or natural regeneration. Qualified expenses do not include the value of the owner's own labor. Amortization allows you to deduct reforestation expenses that exceed the $10,000 annual limit over an 84-month period. Special rules govern calculating the annual amount you can amortize. Family forest owners may lose timber and other assets to natural disaster or theft. In the business and tax sense, losses can be categorized as operating losses, capital losses, or involuntary conversions. Operating losses result when expenses exceed income. Capital losses can arise from the sale, exchange, or involuntary conversion of assets held for the production of income. Losses that stem from the sale or exchange of personal use property are not deductible unless they result from involuntary conversion. Involuntary conversion results from complete or incomplete destruction, theft, seizure, or condemnation. The deductibility of operating and normal capital losses is important, but not necessarily unique to timber owners. Involuntary conversion losses, however, receive special tax treatment. Tax deductions for involuntary conversions are available to all timber owners. The treatment of losses is detailed and complex, and beyond the scope of this presentation. Each type of loss is governed by special rules and procedures for calculating the actual amount of loss permitted by the IRS. If you incur a loss, we strongly recommend doing further reading and then talking with your tax advisor before completing your tax return. With losses, as with all other aspects of taxes, good records are required, so let's turn now to a few details about record keeping. The importance of record keeping cannot be overemphasized. The time invested in keeping records literally can pay its way. When claiming deductions, your qualification or disqualification depends on having timely, complete, and accurate records. As mentioned earlier, under category of forest activity, the IRS judges an owner's material participation on the number of hours spent on all aspects of the woodland activity. Thus, your records must accurately document your time spent on qualifying activities. The IRS does not require any special type of record-keeping system or set of books, only that your records show income and expenses for an annual accounting period, be available for IRS inspection, and be kept as long as required for the administration of any internal revenue law. There are several good methods for keeping your records. Your best choice depends on how much time you want to invest, how well you like doing record keeping, and the complexity of your woodland operation. Generally, the more complex your operation, the more detailed your records should be. Regardless of your record-keeping method, every good record should contain at least 4 elements. Date, detail including who, what, where, and why, dollars of expense or income, and direction to where related information is filed, in other words, cross-referencing. This 4D approach to record-keeping is an easy way to ensure your records are complete. The overall key to record-keeping is not what method you choose, but that you actually use it consistently. Even with the best of records, there will be times when you know that outside help with your taxes is needed. You may only need limited help on a one-time basis, or you may want to seek the ongoing help of a professional tax advisor. Either way, here are some tips for finding and evaluating tax help. Tax assistance is available from many sources, including individuals and printed material. Oregon licenses its income tax professionals. Most common are certified public accountants, enrolled agents, licensed tax consultants, and licensed tax preparers. CPAs have the broadest training, covering all aspects of public finance, including taxation. While many have chosen to specialize in taxation, others have not. Thus, their current knowledge of taxes can vary. Enrolled agents, LTCs, and LTPs focus primarily on taxes. Qualified LTPs have successfully completed Oregon's minimum training and tests. LTPs must successfully complete a 2-year apprenticeship under an LTC or CPA and then pass the next higher test to qualify as an LTC. Enrolled agents must either have passed a national test or have worked for the IRS Audit Division for at least 5 years. Categorizing tax professionals as we've done here does not imply a good, better, best hierarchy. The best situation is the one that matches your needs with the professional best equipped in terms of training, experience, temperament, availability, and so on to meet your needs. After locating some potential tax advisors, you'll want to interview them and evaluate their suitability both for you and your particular situation. Questions you should think about are: do they have adequate experience with my situation? Do they listen carefully? Are they qualified? What is their professional reputation? Are they current in the tax field? Are their rates competitive? And are you comfortable with them? If the answer to any of these is no, then keep looking. And it's a good idea to ask yourself if you're really prepared to sit down with a tax professional. Pertinent questions are: do you understand your questions and what services you need? Are your documents organized and complete? Are you willing to provide all the information that they need? And are you willing to give them adequate lead time to get the kind of job you want done? If you can't answer these questions with a yes, then it might be a good idea to spend some time to make sure you're ready to hire a professional. Family forest owners face many potential taxes on their operations. We've looked at several aspects of those taxes, focusing on how the federal government taxes income from forest operations, key tax topics to help avoid problems and minimize taxes, what expenses are deductible, and where to get help with forest income tax questions and problems, and what questions to ask. Federal tax liability on a family forest operation can be substantially reduced, but it takes careful planning, good records, and sometimes professional help. Listed here are several publications and websites that can help you with your tax planning. Thank you for watching this presentation. I hope you found it useful and informative.